Welcome to Griffonomics. Today we're diving into V2X Inc., trading under the ticker VVX. V2X is executing a rapid, highly profitable corporate transformation that pairs a record-shattering backlog with advanced automation. However, this transition has triggered an analytical conviction gap on Wall Street, where legacy service sector models are being mispriced against a rapidly scaling, tech-enabled compounding machine.
Yeah, that conviction gap is, it's really the core of the whole mystery here.
It really is. I mean, think about this for a second. We literally just saw a major Wall Street firm downgraded a defense contractor today.
Yeah.
And their reasoning, they're terrified that artificial intelligence is just, going to absolutely decimate their billable hours.
Right.
But what if that same contractor is actually the one wielding the AI to basically monopolize the military logistics space? It's a complete disconnect.
A massive disconnect.
So today we are looking at a stack of institutional forensic reports, earnings transcripts, regulatory filings, and Wall Street analyst notes, including that major downgrade that just dropped today, June 24th, 2026.
The timing is incredible, honestly.
Yeah, so whether you are an allocator building a portfolio, an analyst tracking defense tech, or, just someone fascinated by the mechanics of corporate turnarounds, our mission for this deep dive is to figure out who is right. Because we have explosive fundamental performance from V2X on one side, and then a highly nervous market reaction on the other. Okay, let's unpack this.
Yeah, let's do it.
We're dealing with a classic variant perception setup here, where looking at the exact same data, the market is staring at a perceived ceiling, but the mechanics point to an absolute breakout.
The disconnect really stems from how you classify the company in the first place. Like if you look at V2X through the lens of a traditional legacy government services provider.
It's like a generic body shop.
Exactly. The kind of company that just provides manual labor for motor pools or, standard IT help desks.
Yeah.
If that's your lens, your financial models are going to flash warning signs all over the place. But if you actually look under the hood at what they're building today, those legacy models just completely fall apart.
Well, let's start by looking under that hood, specifically at the first quarter of fiscal year 2026, because calling it a blowout almost does it a disservice.
It really does. The numbers are wild.
Let's dissect the accounting math here. So for Q1, V2X posted a 23.4% year-over-year organic growth rate, driving quarterly revenue to $1.254 billion. And, I really want to emphasize the word organic here.
Yes, that's crucial.
Right, because we aren't talking about some roll-up strategy where they just, bought a bunch of smaller firms to artificially inflate the top line. This is internal compounding.
And that organic figure is what immediately jumps off the page for anyone following the space. Because look, in the government, IT, and logistics sector, your standard organic growth traditionally hovers around 3 to 5%.
Right. It's normally very slow.
Very slow. You are essentially operating a utility.
Mm-hmm.
You have this massive, slow-moving contract base that basically just grows alongside inflation or maybe some modest defense budget bumps.
Right.
So when a $4.5 billion enterprise suddenly accelerates its organic growth to 23.4%, it completely breaks the historical comparables. Like, that is software company velocity, but it's operating inside a legacy defense prime framework.
And it flowed straight down to the bottom line, too. I mean, they posted a massive 55% surge in adjusted diluted earnings per share, hitting $1.53.
Which is just staggering when you look at the estimates.
Yeah, the Wall Street consensus was sitting way down at $1.24. They completely demolished it, and we can see exactly how they did it when we look at the margins. Adjusted EBITDA expanded 28% year-over-year to $85.6 million, allowing them to sustain a 6.8% operating margin.
Right.
And pure net income for the quarter was $18.9 million, but the adjusted net income hit $48.1 million, which is up 53%.
The margin expansion is the absolute tell here. When a company is growing its top-line revenue at 23%, but its EBITDA is growing at 28%, it means mathematically they're earning more profit on every new dollar coming in the door.
Yeah.
They're fundamentally changing their business mix.
But how does that actually work in practice? Because, it feels like we're watching this massive 16,000 employee cargo ship spread across 349 global locations, and it suddenly accelerates like a speedboat. You don't just flip a switch and earn a 55% premium on your earnings.
No, you definitely don't.
So what are they physically doing differently on the ground to drive that kind of margin?
Well, they are actively walking away from commoditized work.
Okay.
Historically, a lot of defense services contracts were basically just body shop labor, like we said earlier. The government comes in and says, we need 50 people to turn wrenches at this base in Germany, and the contractor just provides the people, charges an hourly rate, and takes a tiny percentage fee on top.
Which is super low margin.
Incredibly low margin and highly competitive. Anyone can bid on that. What V2X is doing now is shifting heavily toward highly specialized technology-enabled mission support. So they are bidding on complex systems integration, cyber hardening, predictive logistics.
Stuff other people can't do.
Exactly. They are aggressively moving up the value chain.
So they're taking on harder problems that inherently command higher premiums, which makes today's market event just all the more baffling to me.
Downgrade.
Right. We have surging profits, expanding margins, massive organic growth. And yet today, Raymond James officially downgraded V2X from an outperform rating to a market perform rating.
It's fascinating, really. The analyst behind the downgrade, Brian Geschwal, actually outlined a really interesting rationale for it, because he made it explicitly clear that the downgrade has nothing to do with fundamental underperformance.
Wait, really? He admitted that?
Yeah, in his note, he specifically admits that Raymond James's own internal models for V2X are currently sitting above the broader Wall Street consensus.
So he knows the company is absolutely crushing it, but he's downgrading the stock anyway. Let's really dig into that structural sector concern. From what the note says, this is driven by a valuation ceiling combined with a macro fear about artificial intelligence.
Right, those are the two pillars of his argument.
Let's start with the valuation front. V2X's stock surged 50% year-to-date after that huge Q1 print, hitting a trailing price-to-earnings ratio of 29.7x.
And when you compare that 29.7x to their historical 5-year median PE, which sits around 24.89x, the knee-jerk reaction for a traditional analyst is to say the multiple has stretched as far as it can possibly go.
Like a rubber band pulled tight.
Exactly. They think it has hit a ceiling. But the more systemic issue, Giswell highlights, the real meat of the downgrade, is the structural fear surrounding AI in the GovIT space.
This is the whole hourly labor billing model fear, right?
Correct. Wall Street is currently possessed by this narrative, this terror, really, that AI is going to act as a grim reaper for billable hours.
Right, because if your entire revenue model is built on charging the government for the thousands of hours it takes human beings to process logistics, file maintenance reports, or monitor networks.
The assumption is that an AI agent will just step in and do that work in seconds, and therefore the revenue model completely collapses.
But when you hold that narrative up against V2X's actual financial reality, the variant perception is just blinding. I mean, Wall Street is terrified about future revenue evaporating, but V2X is sitting on a historic, record-shattering $13.8 billion total backlog.
Yeah, the backlog completely destroys that thesis.
And let's look at the price earnings to growth ratio, the PEG ratio, for a second. Because staring at a trailing PE of 29.7x misses the point entirely.
The PEG ratio is the ultimate equalizer here, because if you are growing earnings at 55%, a 29x PE is actually quite cheap.
Right.
And right now, V2X trades at a PEG ratio of just 0.25.
For you listening, a PEG ratio under 1.0 generally suggests a stock is undervalued relative to its growth rate. So a 0.25 PEG is Wall Street just severely discounting the growth engine that V2X has built.
Because they simply don't believe the growth is sustainable. They think the AI disruption is lurking right around the corner. But again, the backlog data completely refutes that fear. V2X management updated their full-year 2026 revenue guidance to a midpoint of $4.90 billion. And today, 94% of that guidance is already explicitly under contract.
I just want to let that sink in for a second. 94%.
It's essentially a lock.
Right. We have a market that is panicking about theoretical macroeconomic shocks, potential budgetary gridlock in Washington, the existential threat of AI. Meanwhile, V2X has essentially bulletproofed its 2026 revenue. They achieved a 3.2x book-to-bill ratio in Q1 alone.
Which means they booked $3.20 in new business for every single dollar they billed out.
That ironclad visibility is what Raymond James is missing, but focusing on the trailing PE. Having 94% of your year safely under contract provides a structural fortress. The downgrade is heavily indexing on legacy billing models that V2X is already evolving away from.
And they're looking in the rearview mirror.
No, exactly. So if the analyst thinks AI is going to kill V2X's business model, we need to look at what V2X is actually doing with artificial intelligence right now.
Because they aren't ignoring it.
Far from it. We have a strict forensic audit of their technology joint ventures right here, and it completely flips the Wall Street narrative on its head. V2X isn't the victim of AI. They are the ones aggressively deploying it to build a massive moat. Let's explore this go towards tomorrow strategy they've laid out.
The strategy is brilliant, mostly because of its pragmatism. Like, they aren't trying to build a massive proprietary foundational AI model from scratch.
Which would cost billions.
It would be a massive capital sink, and they'd probably fail. Instead, they are forming alliances with the absolute best commercial tech giants in the world, and they are serving as the heavily cleared, highly secure bridge to deploy that tech inside the Department of Defense.
Let's walk through the mechanics of the first major alliance, which is with Google, Tactile, and NVIDIA. They are building an advanced aerospace lifecycle predictive maintenance engine.
It's a mouthful, but the actual application is incredible.
I really want to ground this in reality for the listener. How does military maintenance actually work today, physically, and how does this AI integration change the physical actions of a mechanic on a flight line?
Today, the system is mostly reactive. It is a strict break-fix model.
Okay.
Let's say a mechanic is out inspecting an F-16 or, a Black Hawk helicopter. They see a worn seal, or they hear a strange vibration in the engine. Right now, they write down a note on a clipboard, or maybe they dictate a voice memo into a ruggedized tablet, or snap a quick photo of the component.
Which is highly fragmented, unstructured data.
Highly unstructured and often completely siloed. That photo and that voice note might just sit on a local server at that specific base in, say, South Korea. It doesn't inform the broader global supply chain until the part actually breaks.
Oh, wow. So nobody knows there's a problem until the jet is grounded.
Exactly. And once it breaks, the aircraft is grounded, which creates a severe strategic vulnerability, and the logistics chain has to frantically scramble to locate a replacement part somewhere in the world, ship it, and schedule the emergency repair.
Enter the Google and NVIDIA alliance.
Right. V2X is taking all of that fragmented, messy, global field log data, the voice dictations, the dirty photos of components, the handwritten scribbles, and they are ingesting it all into a secure Google Cloud data lake.
Okay.
Then they're utilizing Google Gemini models to parse it. And this is where the mechanism is just vital to understand. Gemini is an incredibly powerful multimodal LLM.
Right. It can process text, audio, and images all at once.
Yes. So it could look at the photo of the worn seal, read the mechanic's messy voice transcript, cross-reference it against millions of historical maintenance logs processed by NVIDIA compute power, and realize, oh, this specific wear pattern needs this exact component will fail in exactly 21 days.
So it completely eliminates the break from the break-fix model.
It shifts the entire paradigm to machine-driven predictive scheduling. The AI doesn't just flag the future failure. It goes a step further. It automatically scans V2X's global inventory, locates the spare part at a different facility halfway across the world, and recommends a proactive part transfer.
So the component arrives at the flight line before the seal actually breaks.
The aircraft never experiences unscheduled downtime.
And this ties directly back to why the Raymond James downgrade just totally misses the mark. If V2X is getting paid by the hour to fix broken jets, then yes, AI making things more efficient would inherently hurt their billable hours.
Right.
But they aren't selling hours anymore. They are selling aircraft availability. They are capturing outcomes-based contracts.
Yes,
the military pays them a massive premium to guarantee, say, a 90% readiness rate. If V2X uses AI to achieve that readiness rate with significantly less manual labor, their overhead drops, and that margin flows straight to the bottom line.
It's internal cost efficiency combined with a vastly superior product. And they are expanding this playbook rapidly. Look at the landmark alliance they announced in January 2026 with Amazon.
Yeah, this one requires some serious unpacking. Because V2X is injecting Amazon's commercial robotics, automated physical sorting, and edge-computed computer vision AI models directly into secure military frontiers.
It's wild to think about.
I mean, I have to push back here a little bit. An Amazon fulfillment center in Ohio is a pristine, hyper-controlled environment. You have perfectly flat, concrete floors, perfect Wi-Fi, climate control. How on earth do you take delicate commercial robotics and edge computing and deploy it to a forward operating base in a hostile environment?
Well, that is exactly the moat. That's the secret sauce.
How so?
Amazon has the technology, obviously, but Amazon does not know how to run logistics in a literal war zone. V2X does. V2X holds massive vehicles like the $82 billion LOGCAP-V contract, which essentially makes them the primary provider of base operations support for the Army globally.
Right. They know how to build ruggedized infrastructure.
Exactly. So the edge computing is the key here. You can't rely on a pristine 5G connection to a cloud server when you are operating in a contested military environment where adversaries might be jamming signals.
Right. The cloud is useless if you can't reach it.
So V2X is taking Amazon's computer vision AI models and running them on ruggedized local servers at the edge. So you have automated physical sorting systems tracking military supplies in real time, functioning perfectly even if the broader global network goes down.
It vastly reduces the physical labor friction. You are basically automating global fulfillment networks for the DoD.
And we have to cross-reference this Amazon partnership with the alliance. V2X struck with Elastic in March of 2026. This adds a whole new layer of cybersecurity to the logistics chain.
Yeah, the Elastic partnership is where the data from Google and Amazon kind of comes together securely. V2X is embedding Elasticsearch and Elastic Agent Builder to deploy real-time agentic software analytics.
The word agentic is crucial here.
Let's define agentic for the listener because it's a buzzword that gets thrown around a lot in tech circles right now. What is the actual mechanism of an agentic AI in a cyber defense context?
Sure. So traditional analytics are passive. A system monitors network traffic. It spots an anomaly, say a strange login attempt on a military supply chain server, and it sends an alert to a human analyst.
Right, a red blinking light on a dashboard.
Exactly. And then the human has to read the alert, investigate the logs, and take action to stop it. An agentic AI actually has agency. It doesn't just alert, it acts on its own.
So if it spots that irregular login,
The agentic software can instantly correlate that login against multi-source data insights. It sees the login as coming from an IP address in a hostile region, and it sees they are trying to access a manifest for the F-16 parts we talked about earlier. In real time, the AI autonomous agent quarantines the server, blocks the IP, and reroutes the secure data flow, all without waiting for a human to wake up and hit a button.
it's instantaneous defense. And Wall Street is looking at all of this: Google, Gemini, predictive maintenance, Amazon, edge computed robotics, Elastic agentic cyber defense, and somehow concluding that V2X is a legacy dinosaur about to be disrupted.
That's almost comical when you lay it all out.
It is. V2X is clearly the premier intermediary scaling big tech securely inside DoD firewalls.
And look, the tech giants need V2X just as much as V2X needs them. Google and Amazon don't have the decades of operational intimacy, the DCAA compliance infrastructure, or the specific facility clearances to just walk onto a classified military base and start installing software on secure networks.
They legally aren't allowed to.
Right. V2X is the toll booth.
Uh-huh.
If big tech wants DoD revenue, they have to partner with someone like V2X.
And this massive technological upgrade isn't just an R&D experiment, right? It is actively translating into definitive, highly lucrative contract roll-ons right now.
Well, absolutely.
Let's look at how this tech mode actually secures unassailable revenue streams, because we've got a list of non-shared high-margin program wins here that act as long-horizon call options for future cash flow.
These contracts are the physical manifestation of the margin expansion we discussed earlier. Let's look at the F-16 IDIQ, for example.
This is a $425 million single award IDIQ running out of their Indianapolis facility through September 2035. Now, for anyone listening who doesn't spend their days reading dry DoD procurement filings, IDIQ stands for Indefinite Delivery, Indefinite Quantity.
It's a very specific mechanism.
Yeah. Mechanically, an IDIQ is basically a hunting license. The government is saying we are allocating up to $425 million for F-16 cockpit modernization over the next decade. We don't know exactly how many planes are going to need it or exactly when, but when we do issue a task order, you are the exclusive contractor allowed to hunt for it.
And because it is a single award IDIQ, V2X doesn't have to constantly compete against other primes every time a new batch of F-16s rolls in for modernization. They own the entire ceiling.
That's incredible visibility.
And the work itself, cockpit modernization, is deeply complex systems engineering. You are integrating modern digital displays, advanced targeting sensors, and new communication nodes into an airframe that was literally designed decades ago.
It's incredibly sticky revenue because once you have a team of engineers in Indianapolis who deeply understand the proprietary integration of a specific F-16 variant, the government's switching costs become astronomical.
Exactly. They aren't going to fire V2X midway through the decade and hire a new prime to start from scratch. It would be a logistical nightmare.
And the same logic applies to the Navy's KC-130J aircraft survivability systems integration, which is taking place down in Crestview, Florida.
Right. They're integrating LARCM systems onto those planes.
LARCM systems, that's large aircraft infrared countermeasure systems. And again, this isn't just bolting a new radio into a dashboard. A KC-130J is a massive tactical transport aircraft. A LARCM system uses advanced laser technology to detect an incoming heat-seeking missile, track its trajectory, and then literally fire a directed laser beam into the missile seeker head to blind it and knock it off course.
The precision required to integrate a system that fires lasers at supersonic missiles onto a legacy cargo plane is staggering.
I can't even imagine.
The tolerances for error are literally zero. Lives depend on it. So when V2X proves they can execute that level of high-margin, zero-fail engineering, they cement their status as a Tier 1 integration partner for the DoD.
Speaking of Tier 1 integration, we have to touch on the Army Gateway Mission Router contract. This is a $72 million win to build cyber-hardened routers feeding the Pentagon's CJAC2 network architecture.
Yes, CJADC2, Combined Joint All-Domain Command and Control.
What a mouthful.
It really is, but CJADC2 is basically the holy grail for the modern military right now.
How so?
The concept is to connect every single sensor on the battlefield, from an F-35 flying in the air to a destroyer out at sea to a soldier on the ground, into one unified, seamless data network.
And V2X is building the physical routers for it, but the notes here specify cyber-hardened routers. What does that actually mean mechanically in this context?
It means the physical hardware and the embedded software are designed from the ground up to resist electronic warfare.
Okay.
If a near-peer adversary tries to jam the network or inject malicious code into the data stream, the V2X router has to be able to detect it, isolate the threat, and power through the attack to ensure the battlefield data keeps flowing to the commanders. And again, this points right back to their elastic partnership for cyber anomaly detection.
It's all connected. The tech alliances are directly feeding the contract wins. But if you want to talk about true generational cash flow visibility, we really have to look at the U.S. Army's Flight School Next competition.
Well, this is the big one.
The sources provide a critical status update here. The team of Bell Textron and V2X has advanced to Phase 4. They are one of only 2 remaining finalists competing for this.
And the scale of Flight School Next is just, it's difficult to overstate. This is a massive 26-year contractor-owned, contractor-operated training pipeline, a COSI model.
I want to ask you, as someone who watches this space closely, how does a 26-year pipeline alter the very DNA of a defense contractor? Because you're no longer just bidding year to year to keep the lights on?
No, it transforms the company into a multi-decade institution. Under a COSIO model, the contractor actually owns the physical helicopters. They own the flight simulators. They provide the civilian instructors.
So what does the government actually do?
The government just pays for the output.
Yeah.
They pay for fully trained combat aviators to be handed over to them. When you have a 26-year cash flow horizon guaranteed by the U.S. government, your capital allocation strategy completely changes. You can finance massive long-term R&D projects because you know the money will be there. You attract the absolute best engineering and aviation talent in the industry because you can offer a quarter-century of stability.
And from a valuation perspective, an asset with 26 years of highly predictable government-backed cash flow deserves a massive premium.
Absolutely.
Not a discounted 0.25 PEG ratio. And V2X has already proven they can handle this specific type of aviation work. The sources highlight that in Q1 alone, they booked $3.3 billion from the $4.3 billion T6 flight training program.
Right. They are already executing on these massive aviation readiness contracts.
And they've even reforecasted that specific program upward to generate $175 million to $180 million annually. So the capability is undeniably there.
They are executing flawlessly on the operational side. But look, taking on massive COCOs, contracts, and integrating global AI systems requires intense financial discipline. A company can have all the right tech and win all the right contracts, but if their balance sheet is a mess, the whole thing crumbles under its own weight.
Which perfectly sets the stage for the aggressive financial engineering we've seen from V2X over the last 30 days.
Right.
Because CFO Sean Ural has executed what looks like an absolute masterclass in balance sheet de-risking. Let's dissect this, starting with the debt repricing.
This just happened on June 1st, 2026. V2X enacted Amendment Number 6 to its first land credit agreement. They held an $868.52 million term loan that matures in December 2030.
Which is a heavy debt load.
It is, but they went to the debt markets and successfully repriced that massive loan down to SOFR plus 2.00%.
SOFR being the secured overnight financing rate. Now, getting a better interest rate spread is obviously good, but the sources specifically highlight a deeply technical detail here. They completely scrubbed the 0.75% interest rate floor that was attached to the previous debt.
This is such a crucial detail.
Can you break down the mechanics of an interest rate floor and why removing it is such a massive win for their free cash flow?
Absolutely. When a company holds floating rate debt, the interest they pay naturally fluctuates based on a benchmark, like SOFR. If global interest rates go up, their interest payments go up. If rates go down, their payments go down.
Makes sense.
But lenders often demand an interest rate floor to protect their own downside. A 0.75% floor means that even if the SOFR benchmark drops to absolute zero, V2X is still legally obligated to pay a minimum baseline of 0.75% plus the 2.00% spread.
So it's essentially a built-in penalty if macro conditions actually improve for borrowers.
Precisely. It caps how much V2X can benefit from rate cuts. By scrubbing that floor completely out of the amendment, V2X removes that artificial bottom.
Meaning if interest rates drop significantly in the coming years, V2X gets to capture 100% of the benefit of those lower rates.
Exactly. It vastly reduces their borrowing frictional costs. And every single dollar they save on interest payments is a dollar of free cash flow that drops straight to the bottom line, fueling their capacity to invest in more AI joint ventures or bid on larger IDIQ contracts.
So they successfully optimized the debt side, creating a much leaner, more aggressive capital structure. But the equity side of the equation is arguably even more fascinating here.
Oh, without a doubt.
Let's talk about the sponsor exit that occurred in May 2026, just a few weeks prior to the debt repricing, because this solves one of the biggest structural issues that was suppressing the stock price.
Yeah, V2X had a legacy private equity sponsor, American Industrial Partners, who were operating via an entity called Vertex Holdco. And AIP held a massive concentrated position in the stock.
And in the public markets, a massive private equity concentration creates what's known as a technical selling overhang.
It's brutal for a stock.
I always think of it like trying to drive a high-performance sports car with the emergency brake pulled all the way up. It doesn't matter how powerful the engine is, or in this case, how strong the fundamental earnings growth is, the stock just can't accelerate.
The emergency brake analogy is perfect.
Right.
Because every institutional buyer looking at V2X knows that the private equity firm's ultimate goal, eventually, is to exit and return capital to their limited partners.
Right.
So the market lives in constant fear that the moment the stock price rallies on good news, the PE firm is just going to hit the bid and dump millions of shares onto the open market, flooding the supply and cratering the price.
So new money refuses to buy in. They just sit on the sidelines waiting for the dump.
But in May, American Industrial Partners fully liquidated its direct concentration. They executed a 2 million share secondary block offering, handled by Morgan Stanley, at $73.91 per share.
And the critical mechanical point here is that this resulted in zero equity dilution.
Yes, exactly. V2X, the company, didn't issue 2 million new shares and dilute the existing shareholder base. It was a secondary offering. Morgan Stanley just facilitated the transfer of those existing shares from the private equity firm to new institutional buyers.
And now AIP's stake is down to just 1.2%.
The technical overhang is completely removed. The emergency brake line has been cut. The stock is finally free to trade on its actual fundamental merits, like the 55% EPS growth and the 23.4% organic revenue growth, without the psychological weight of a looming insider liquidation.
So you have operational acceleration meeting financial optimization at the exact same moment. They've tuned the engine, they've cut the brake lines, and they are targeting a net leverage ratio of less than 2.0x by the end of 2026.
They are incredibly well positioned.
And the sources note they still have $70 million remaining on their active share repurchase authorization, so if the market keeps pricing them at a 0.25 PEG ratio, management has the dry powder to just aggressively buy back their own undervalued equity.
It is a textbook corporate transformation, really. It is.
All right, we have covered an immense amount of ground today. We've dissected the explosive Q1 financials, the irony of the Raymond James downgrade, the massive tech alliances with Google, Amazon, and Elastic, the multi-decade contract horizons, and Sean Ural's balance sheet optimization.
It's a lot to process.
It is. So it is time to synthesize this entire investment case and deliver a final verdict. Is an enterprise acting as a cycle-resistant cash machine at current valuations, a structural value play for allocators?
I think if you accept the premise that V2X is no longer a legacy services provider, but rather a tech-enabled, highly automated civil military infrastructure champion, the valuation is incredibly compelling.
The narrative just doesn't match the numbers.
Right. The transition from manual labor hours to predictive AI-driven mission outcomes fundamentally alters their margin profile and their defensibility.
And we should note the cycle-resistant nature of their revenue stream, too. The sources indicate they've achieved a 21% non-core customer revenue diversification, meaning 21% of their revenue is now sourced outside of the traditional domestic defense branches.
That acts as a massive shock absorber against any localized DoD budget cuts or political maneuvering in Washington.
Right. However, no investment thesis is devoid of risk, and the forensic audits we have do outline several near-term execution hurdles that have to be monitored closely.
Yeah, you can't ignore the risks.
Let's lay out those potholes. What are the primary execution risks here?
First is competitive bidding recompete exposure. While a $13.8 billion backlog is phenomenal, a vast majority of their business still relies on the U.S. government procurement cycle.
Meaning contracts eventually end.
Exactly. As massive base operations contracts approach their expiration dates, V2X has to defend them. If a competitor underbids them or offers a superior technological package on a major logistics hub, V2X could face an instant material revenue hole.
The hunting license goes both ways. What is the second risk?
Strict regulatory compliance tracking. Operating inside the DoD ecosystem means operating under the intensely watchful eyes of the DCAA, the Defense Contract Audit Agency, and the DCMA, the Defense Contract Management Agency.
And those agencies, they do not mess around. The accounting mandates are incredibly heavy.
They require flawless, granular tracking of every single cent spent, every hour billed, and every piece of material moved. Integrating commercial AI from Google and Amazon into this heavily regulated environment is a massive compliance burden.
Because AI can be unpredictable.
Right. If an AI agent hallucinates or makes an undocumented routing decision that violates DCAA mandates, the fallout is severe. Non-compliance can trigger heavy contract modifications, massive financial penalties, or even being barred from future government bidding.
You can't just move fast and break things when you're dealing with military logistics.
Yeah.
And the third risk.
The third is the temporary congressional funding freeze on the Flight School Next initiative. We discussed the transformative nature of that 26-year contract pipeline earlier.
Right, the co-CO model.
But right now, the entire program is in a holding pattern pending an administrative report to Capitol Hill. While V2X is a top 2 finalist, political gridlock, shifting committee priorities, or broader budgetary battles in Congress could significantly delay the award.
Or they could alter the scope of the contract or cancel the co-CO model entirely.
Exactly. It's tied up in politics right now.
So, wrapping this all up, why does this deep dive matter to you, the listener? In a market that is currently hyperventilating over the AI disruption of service industries, V2X offers a masterclass in adaptation.
They really do.
They didn't put their heads in the sand. They didn't try to protect low-margin manual labor. They actively absorbed the very technology Wall Street fears, using it to expand margins, automate overhead, and build an unassailable technical moat inside the world's most secure ecosystem.
They recognize that the future of defense isn't about supplying more people. It's about supplying better, faster, and more predictive outcomes.
Which brings me to a final provocative thought for you to explore on your own. Wall Street assumes that AI is this great democratizing force that will wipe out legacy businesses and level the playing field.
That's the common narrative.
But look at the realities of the Department of Defense. Look at the extreme security clearances, the massive DCAA compliance tracking, and the handling of classified data. Could artificial intelligence actually create a winner-take-all monopoly dynamic in defense contracting?
That's a fascinating question.
If only a few elite primes like V2X have the facility clearances and the regulatory trust to legally operate Amazon and Google's AI inside military firewalls, doesn't the sheer complexity of AI actually make these specific contractors permanently irreplaceable?
It's a compelling paradox. The technology that is supposed to disrupt the incumbents might just be the exact mechanism that cements their dominance forever.
So the next time you see an analyst downgrade a stock based on a macro narrative, take a closer look at the actual mechanics on the ground. Sometimes the market is so obsessed with finding the disruption, they completely miss the evolution. We'll see you next time on The Deep Dive.